The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. I'm your host, Dan Sipe. I'm actually the founder of Serving Those Who Serve, and additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. I'm going to kick this off, as I always do, by saying thank you. Number one, thank you for taking the time to watch or listen. We know your time's valuable. Thanks for spending it with us. But also, thank you for your service to the government, to the country, to me, to everyone. In normal times, you don't hear it enough. These are not normal times. For the past 18 months or so, definitely not normal. So thank you for weathering the storm. We're in it with you, and we will all get to the other side. The other thing you're always going to hear here is my buddy, Ed Zerndorfer. The guru is back here once again as part of our ongoing mission to reach, teach, and serve you, career civilian Fed. So once again, we're following Ed's FedZone articles. Okay, that's fed-zone.com. Go over, check it out. To say it's a plethora would be an understatement. He's been popping these babies out since about 2018. They're searchable, university level education in there. But this also gives us one more way to reach and teach. And today we are talking about something you're not getting anywhere else, especially not in those 1-hour webinars that teach you everything you need to know about your federal benefits in one single hour. Wow, that's amazing. Those cats must be really smart, way smarter than us, Ed, because we haven't figured out how to do that. So today, we're talking about estate planning. And it's like, well, I'm not a rich guy. I don't have to worry about estate planning. You might. And the estate planning tool we're talking about that a lot of federal retirees have never heard of is called disclaimer. And here's why it matters. The number of TSP millionaires hit a record high in October of last year, 189,000, almost 190,000. Okay. And those large accounts can create some real tax headaches. So Ed's going to explain how the disclaimer works and why estate attorneys are increasingly building them into their clients' plans. So Ed, let's start at the top. What exactly is a disclaimer? And what happens to an asset when an heir decides to disclaim it? Shoot.
Well, a disclaimer is nothing more than a strategic rejection of inherited asset. Someone names it, let's say a TSP. A TSP participant has named a beneficiary. An IRA owner names a beneficiary of their account. So the person who is the participant has named, let's say one person as the beneficiary of their TSP, and their account is huge, over $1 million. As you said, Dan, there's currently, as of last October 2025, there are 190,000 TSP account owners who have over $1 million in their TSP accounts.
Sure.
Well, the TSP participant has named a beneficiary. The TSP participant passes away, and it has an account over $1 million. So the beneficiary stands to receive $1 million of their TSP account. And it turns out that the beneficiary is in a high marginal tax bracket, federal marginal tax bracket, and he lives in a state that has a large state income tax. He says, if I inherit this asset and inherit the TSP, it's going to push me into a higher tax rate. Probably will, especially if you're talking about traditional TSP. because all TSP withdrawals, and the beneficiary has to withdraw it, if the beneficiary is not a spouse, is not a current spouse, it could be an adult, you could say an adult child, it could be a sibling. They have to withdraw the money within a certain period of time, within 10 years. They got to take all the money out and have to pay tax. So that's going to be a huge tax liability. The person says, I don't think this is a good idea for me to inherit this TSP account because it's going to push me into another tax bracket. So they reject it. So now the question is, who's going to get it? Who's going to get the account? So the original TSP account holder is advised, and I get questions all the time, who should I name as beneficiary? Well, you have a primary beneficiary. If you're a married person, usually a spouse. You could name adult children as not maybe beneficiaries, but contingent beneficiaries. What does that mean? It means that if the primary beneficiary, I was using the spouse, passes away before the TSP account owner, then the TSP account would automatically go to the contingent beneficiaries. You also can have secondary beneficiaries, things like that. The point is, and the same thing would hold true with an IRA, is that in case a beneficiary disclaims the asset, disclaims the retirement account, TSP account, retirement account, then the next in line, the contingent beneficiary would receive it. Now, people ask me the question, now what about if you're talking about the Roth TSP, Roth IRA, under the rules, on the IRS rules, when it's inherited, one does not have to pay income tax. Anybody who inherits the Roth TSP or a Roth IRA does not have to pay tax when they take the money out. Do they have to take it out within a certain period of time? If it's not a spouse, the answer is yes. Under Secure Act 2.0, anyone who inherits a Roth account, Roth IRA, has to withdraw the account within 10 years of the death of the Roth account owner. But they won't have to pay tax.
Sure.
But there's another problem here facing a potential beneficiary, and that is estate taxes. A Roth account is part of one's estate. And there is a federal estate tax in this country. Granted, not many people are going to have to pay federal estate tax when they die because this year in 2026, the estate tax exemption for one federal estate tax exemption is $15 million. $15 million. If the person is married when they pass, it's actually $30 million on something called, because the married couple of doubles. Well, a lot of people, I'm sure a lot of people don't have that type of estates. But here's the other problem. There are 12 states in this country that have their own state estate tax. For example, I live in Maryland. Dan, you live in Maryland. What is the state estate tax exemption in Maryland? $5 million. People say, well, I don't have an estate of $5 million. Really? What's going to be included as part of your estate? Do you have a house? What's your house for? Maybe $500,000 to $1 million? Do you have a rental property? Do you have a life insurance policy? Do you own a life insurance policy? Guess what? Your life insurance policy, you own the policy, you named the beneficiary, will be part of your estate when you pass away. But I thought life insurance proceeds that are paid out are not subject to tax. Yeah, income tax, but they're
income tax. Yep.
State. What I'm driving at it, Dan, is it doesn't take much in this day and age to come up with a state that's worth a couple $1 million. I know Oregon has a $1 million state estate exemption. So again, there are a handful of states. The state tax exemption is way below $15 million.
Sure.
So this is another reason that a beneficiary may even may disclaim receiving a Roth IRA or Roth TSP because it's going to drive up the value of their estate, and they may be subject to state estate taxes. So a disclaimer is a way of saying, I don't want it, I had no part of it, and hopefully the participant or the IRA owner named someone in place, because the person who disclaims cannot say, well, I don't want it. Let's give it to somebody else. No, can't do that. Can't do it. It's the original TSP participant, the original IRA owner who has to make arrangements to have, in case the primary beneficiary rejects or disclaims the asset, it will go to someone else. It's up original to the TSP account and TSP and IRA owner to make sure that there's someone next in line to receive the disclaimed asset.
Gotcha. Now, your article also talks about required minimum distributions and that there's a ripple effect within that. Tell us about those.
Yes, that a reason that a beneficiary may want to disclaim the traditional TSP account or traditional IRA is that when they turn 70, when they turn what's called the required beginning, when they reach the required beginning date, which is now 73, they have to take R&D, they have to take a required minimum distribution from their inherited traditional accounts, their accounts. And this is most relevant for a spouse, because under Secure Act 2.0, if someone inherits a traditional IRA account and the IRA owner, when he or she died, had reached their required beginning date, then the beneficiary has to withdraw their inherited IRA within 10 years of the death of the IRA owner. And they have to take RMDs within the 10 years. Each year, they got to take an RMD. Now, the RMD, the amount that they take out at age 73 is equal to 3.8% of the account balance. This is going to be taxable. It's going to add to their other income. It could push them into a higher tax bracket. Plus the fact that, let's say it's a spouse and they've reached their required beginning date. They got to take the money out. They have to pay tax, and it's going to be added. It's going to be part of their AGI. The spouse has a ripple effect in the sense that other things are going to be affected. Like, for example, if the spouse is enrolled in Medicare Part B, they have to pay a monthly premium, and that premium depends on their AGI. So that additional income coming from the R&D is going to be pushing to a higher tax bracket, and result is they're going to have to pay more for Medicare Part B down the line.
Sure.
Medicare Part B and Medicare Part D. It has a ripple effect. And it also may affect other tax deductions and tax credits that are sensitive to one's AGI. The higher one's AGI, the less chance they might be able to get any deductions or credits each year. So it definitely has an effect.
Gotcha. Now, as always, this is what I love about your article, Ed. You give examples, and you walk us through a great example with a family, Howard, Sharon, and their daughter, Sarah, and Sarah's 2 children. So walk our listeners through that story and show how the disclaimer ends up saving the family on taxes.
Yes, I like to learn by example, and I like to pass it on in my writing. That's the way I feel that people can learn best, is through examples. So we have here Howard. He's a retired federal employee. Has a huge traditional IRA worth $1.8 million. Now, where's most of the money from? Dan, a lot of feds, after they have retired from federal service and they had this huge TSP account, they directly transfer it to a traditional IRA. Traditional IRA for a variety of reasons. One reason is they can invest it. They have more investment choices. Another reason is there are things they can do with the traditional IRA that they cannot do with the TSP. For example, they have more withdrawal options. Whatever the reasons is, Howard decided to transfer his entire traditional TSP account to do a direct rollover, and it's worth $1.8 million. Okay? Now, Howard died in 2024. He designated his wife, Sharon, as the sole beneficiary of his traditional IRA. At Howard's death, Sharon rolled over Howard's $1.8 million her inherited $1.8 million traditional IRA to her traditional IRA. Now, her traditional IRA could have been worth hundreds and thousands of dollars. Okay? But the worst thing happened. Sharon died a year after Howard died. Okay? Now, Sharon had designated her daughter, Sarah, as the beneficiary of her traditional IRA. Okay? And Sarah is in a 35% federal marginal tax bracket. That's the next to highest federal marginal tax bracket. The highest marginal tax bracket is 37%. Okay? And she lives in a state that has a 9% state income tax. We're talking a combined marginal tax bracket, federal state, of 44%. 44%. So now, because Sarah is the daughter, she's the adult daughter of Sharon. She's about to inherit Sharon's IRA, and under the provisions of Secure Act 2.0, Sarah must withdraw her inherited IRA within 10 years of the death of Sharon. So Sharon died in 2025, which means starting January 1st, 2026, and ending by December 31st, 2035, Sarah must withdraw the entire inherited IRA. You're talking probably over $2 million here, $2 million of inherited IRA. And she has to take RMDs within the 10 years. Each year she has to take an RMD. Okay? Now, before Sarah does anything, I want to point out, she has two young adult daughters. They're in low tax brackets, probably in the 12, 22, maybe 24% tax brackets. And luckily, Sharon had named her two granddaughters as the contingent beneficiaries, as the contingent beneficiaries of her IRA. She did that. Sharon did that. So what does Sarah do? She disclaims Sharon's IRA. She disclaims her IRA. She disclaims. And what is her rationale? What is her reason to do that? She feels that if she disclaims this $2 million plus IRA, and each of her daughters is going to get half, because they're in a lower tax bracket, they will end up paying less tax than she would on their inherited IRA. Okay? Now, how old are her daughters? They're probably in their late teens, early 20s.
Mm-hmm.
Does Sarah have to do this? No, but she wants to. Now, think about this. Here we have two individuals, late teens, early 20s, who are going to be inheriting $1 million plus. $1 million plus. Each is going to get $1 million plus in an inherited IRA. Any questions come to mind here about a young person inheriting money? I have.
Yeah.
Do you think they can handle that money? Some.
Not all. Yep.
Well, I'm going to put it to you this way. One reason that Sarah may not disclaim, okay, is because she feels her daughters cannot handle this type of inheritance. They just can't handle it. Okay? Another reason that Sarah may not disclaim is perhaps she may need the money somewhere down the line.
Very true.
It may be that Sarah may need the money. Maybe she hasn't bought long-term care insurance. She's 52 years old. She's at a good age now.
Excellent point.
A good age to buy long-term care insurance. Maybe she cannot qualify for it. Maybe she can't afford it. This would be a way of saving for possible long-term care. Okay? What I'm saying is that disclaimers can enable post-death moves based on current circumstances long after an estate plan has been established. But there are more things than really you got to know about disclaimers. You really got to think about this, whether you want to do it or not. It sounds good. Here, Sarah has good intentions that she wants to save as much of this inherited IRA as possible. She doesn't want to be eaten up by taxes, federal and state taxes. She gives it to her daughters, but do her daughters know what to do?
Sure.
What to do? You know, what to do with the money? Are they going to spend it? Are they prepared to pay the taxes?
Absolutely.
They have to pay taxes on the federal and state taxes when they take the money out, and they have to take the money out within 10 years. That's a lot of income,
Yes, it is.
in 1 year. A lot of responsibility.
Absolutely. And see, here's the thing, and it's a great point that you make. The people who build up the asset probably did a lot of planning. I'm not sure there's that many beneficiaries that have plans set up and ready to go when they receive those inheritances. So this could be an awful lot on somebody to try and sort their way through. So let's kind of dig into the basics every one of our listeners should know. So what are the legal requirements for a valid disclaimer? What's the deadline for filing? And what's the rule that you can't already have benefited from the asset?
Yes, a disclaimer it's a legal document. And by the way, just want to say this, we are not attorneys. We're not giving out any legal advice. Anybody's interested in about this a disclaimer, you have to go to an estate attorney in your state that you live, who'll give you all the advice. We're not giving any advice here. We're just giving you the facts. Again, I always say that. Okay. And in fact, I put that out in the article saying anybody want more information, please talk to an estate attorney in your state. So it's a legal document that consists of an absolute and unqualified renunciation of a beneficial interest, use, enjoyment, or ownership of an inherited asset. You're giving up, you're not going to have any part of it. You're giving it up and there's something that you were about to inherit. You're saying, I don't want it. That means you're not going to get any part of it. The person who disclaims via the legal document has in fact passed it to another heir. That's what they're doing. Saying, I don't want it, give it to another heir, typically designated by documents such as a beneficiary form or will or by law. That's what the disclaimer is. That's what the original retirement account owner, in this case, we're using TSP, we're using IRAs, has stated by naming a secondary or a contingent beneficiary. That sets the way that a disclaimer can be done. That the original beneficiary, the primary beneficiary, does not want that any part of that inherited asset. Now, you could have several beneficiaries. You could have primary beneficiaries. You could have three. Each is getting 1/3. So each one, the primary beneficiary would, each one is on their own as far as whether they want a disclaimer or not. So I don't mean to slide that it's only can be one primary beneficiary. It can be broken up. But each beneficiary has to make the decision whether they want to legally document. In order for a disclaimer to be valid, the designated heir claiming must not have benefited from it from the disclaimer. Once a disclaimer is finalized, it cannot be undone. That's it.
Gotcha. And now, Ed, you do raise a red flag in the article about disclaiming assets to a minor. So let's revisit that. So what questions should somebody ask their estate attorney before naming that minor as a contingent beneficiary?
Yeah, the important, in terms of before one names a minor as a beneficiary of a traditional TSP account or a traditional IRA, the TSP account owner, the participant, the IRA owner should check with an estate attorney in their state. Okay, and here are some of the questions that should be asked. Would a court need to appoint a guardian to manage the inherited assets of a minor? Would income to the minor be taxed at the parent's tax rate, the so-called kiddie tax? How would a minor child inherits an IRA take mandatory annual withdrawals from an inherited IRA? I mentioned about Secure Act 2.0 that when anyone who inherited money was a beneficiary from an IRA or retirement account, the person that died after December 31st, 2019 has to withdraw the money within a certain period of time. And the question comes up, how are these withdrawals going to be done? Dan, I want to ask you a question. I know that you are an investment broker. You work for a firm. Have you had situations where minor children actually were inherited money, let's say from an IRA?
We have encountered situations where, sadly, as a result of people dying suddenly,
Yes.
and that type of thing. That has happened, yes.
And if a child's under the age of 18, how is that account handled if the child inheriting the money is under the age of majority, younger than the age of majority?
It's sticky.
Yeah, I mean, I can't imagine a child being able to have, full access to the account without having some type of custodian.
One of the things, and again, we're not attorneys and we don't give that type of advice, but one of the things that we do float to people is you don't want to put yourself in a position where your best intentions lead to someone else petitioning for a conservatorship in how it's going to be managed. You want to have more say in it than that. So yeah, it's very tricky and your points are well taken. Now, finally, Ed, you mentioned charities can be ideal candidates for disclaimed assets, and you use the term triple tax-free. What does that mean, and how does charitable giving fit into the strategy?
So if the contingent beneficiary is a charity, okay, all money goes to charity. We're talking about, let's say, a traditional TSP account, a traditional IRA, a huge account. This account was built up. Remember this, the traditional TSP account was built up with contributions that were never taxed, earnings over the years that have not been taxed. So all the money coming out of it, a traditional TSP account, is fully taxable. It's fully taxable. So whoever, in the case of a charity that inherits the traditional TSP account, when the money is withdrawn, there are no taxes due, because the charity doesn't pay taxes. It's triple tax-free in the sense that the contributions that were made to the traditional TSP account were made with pre-tax dollars. The earnings that have accrued have never been taxed. And a charity doesn't pay estate taxes. So there's no potential estate taxes. It's a win-win-win situation. Okay?
Sure.
So charities are ideal. When in doubt, who to give the money to, you can't go wrong giving it to a charity. And believe me, in this day and age, charities are hungry. I hate to use that given in terms of donations.
Sure.
Oh, they need money given what's happened with the economy, with the world situation. People are hungry. It's inflation. And so on. I mean, I see churches and other houses of worship giving out free food, and I see the cars lined up. We're not talking about 1995 Chevys here. We're talking about
nice cars.
Expensive cars. Because people just are hurting.
Yep. No, couldn't agree with you more. Brother, incredibly helpful as always. And again, you're the only guy doing this, which means we're the only firm doing it. So for that, I'm very grateful. Again, don't know how you keep it all straight, but I'm glad you do. And I'm especially grateful you do it with us.
My pleasure.
Folks, that's a wrap. We are Serving This to Serve. Be sure to subscribe to this podcast on YouTube channel or Spotify. All right, this is an easy lift, folks, but I'm going to tell you why it's important. Number one, we'll ship our latest updates to you, let you know when they go up. But number two, and this is super important right now, when you subscribe, and it doesn't take a lot to do it, you're saying this was good. This is good content. This helped me. This is a good channel. Then that tells the YouTube algorithm that more feds should see it. Why is that important? Ed and I both have encountered people in the last 18 months that had to make life-changing decisions with less than 7 days notice. Breaks my heart. Now, we were able to guide a number of people who were stuck in that situation because they knew about us. They could talk to us. They could reach out. I'm not talking about our clients. I'm talking about feds that are just part of the community that we serve, and we're happy to do it. Help us get the word out. It's a real easy lift to just hit the subscribe button. And if everybody who's watching this does it and continues to do it, then YouTube's going to say, hey, this should be shown to more feds, and then more feds will know that this is there as a resource. So whether it's the podcasts, whether it's Ed's FedZone articles that go all the way back to 2018, university level education, it's all searchable. So help us get the word out. And don't forget about our crown jewel, those live webinars every single week. No, they're not the 1 hour and all your benefits will get you through that nonsense. that's out there in the Facebook ads and things like that. We've got live webinars every single week, live Q&A, and our patent and trademark part 2, where we can dig into to all your individual questions, make sure you understand it. Go to the SWS website. That's swserve.com. See the webinar button, click it. The whole menu is going to come up. So the guru, the rest of us, we're here to reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all of them, and share it with friends. I promise you they'll thank you. And again, be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. He's always got something going in there that most people aren't thinking about that will help you. So signing off for Ed, the crew at Serving the Serve, and me, Dan Sipe. Good luck, Godspeed, and above all, please remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.